I'm going to talk about the home equity line of credit product or a HELOC. If you are in any property groups, you've probably heard people talking about HELOCs. Quite often, you hear people from the US talking about this product. I can say that I've tried to avoid talking about this simply because it's one of those products that isn't for everybody, and there's a lot of hype online. And because there's a lot of hype, it means that people quite often don't understand it. But today I'm going to break down what it is, who it's for, the pros, the cons, and a little bit more. All right, so let's talk about a really exciting product for the right person, which is a home equity line of credit. My name is Anthony Lindsay, and I've been in finance for over 30 years. And I make videos where I explain different products and talk you through the mortgage process. My videos aren't designed to give you financial, legal, or investing advice, and they're certainly not designed that you can replace speaking to a qualified professional who understands your circumstances. Today, we'll be talking about the home equity line of credit or HELOC. So, what is a home equity line of credit? Let's just go through a few things that I want to cover off first. So, first, do not fall for the hype. There's a lot of hype. You see a lot of influencers online talking about it. Don't fall for the hype. They do exist in the UK, and they are certainly not for everybody. So I've seen people talking about these products, and a lot of these people are influencers on social media, on TikTok. They're not licensed individuals. They're people that really make their money by getting clicks. And the boring stuff does not get clicks. So I'm going to talk you through this product in kind of a boring way because I want you to understand that there are features and benefits that might suit or meet your needs, but potentially they don't. In my experience with the HELOC, the people that know about it probably don't qualify for it. And the people that don't know about it, it would probably be a good thing for them to consider with the right advice. So let's just explain what it is. A home equity line of credit is a home equity line of credit. It's a mortgage. It's a type of revolving credit secured against the equity in your home. So in the US and in Canada, it's quite common, but in the UK, there are other products that are similar, but they may not be called HELOCs. So one thing to consider and keep in mind, it's based on having equity in your home. So as we go through the client profile, you'll find that very rarely are younger or newer home buyers going to be eligible for this product because you have to have equity. And when people are first getting on the property ladder, they may have paid down 5 or 10%. So they're not going to have equity. And this would not be the right product for them anyway. So now that we've talked a little bit about what the definition of it is, let's just talk a little bit more about the specifications of it and who it might be good for. So it allows you to borrow money using the equity in your home, as I said. So the equity is the value minus the mortgage you still owe. So explaining that in very simple terms, if you have a home and your home is worth 500,000 and you owe 250,000. So you are paying a mortgage on 250,000, but your house is worth 500,000. That means you have 50% equity. That's an important thing to understand because with this product type, you do have to have equity in your home. So it works similar to a credit card where you can borrow and repay and reborrow funds up to a set limit. It's flexible borrowing, and it's often interest only during the drawdown period. You pay interest on what you use. So we'll have some examples later on, but there is a difference between what they call installment credit and revolving credit. So installment credit would be like you go and get a personal loan, it's over 36 months, you borrow, let's just say £5,000, you pay a specific amount every single month. So you have a fixed payment every single month. That's installment credit. Revolving credit or credit card credit is very different because, as you know, you can overpay, but there will always be a minimum payment that you're required to pay. If you're one of those people that clears your credit card every month, then you'll know you just pay the full balance and then the available credit is there for you the next month. Or you might pay half of the balance and then the credit available to you is going to be a little bit lower. So the home equity line of credit or HELOC works more like a credit card than a mortgage. It is in the UK. So in the UK, while the HELOC isn't a commonly used term, there are some similar products. So you might have heard it referred to as a flexible mortgage, an offset mortgage, further advance or drawdown facility, and it's secured lines of credit or a second charge. Now, a HELOC will be a second charge. I'll explain that a little bit more. So these let the homeowners release equity in their home without remortgaging their entire property. So we're going to go through some examples, but the key thing to remember in this is you will be given a credit line. So that would be similar to like your credit card. You can draw down or take out some of the money, but it is not a mortgage. So there are, like, I think they said there's a couple million people that within the next 18 months will be coming off really low interest rates. So interest rates starting with a one because they were around the time of COVID. So you have people who already have a mortgage and it's on a really low rate. And until that rate ends, they don't want to remortgage because that would be silly, but they do need access to funds. So it is possible that after doing your due diligence, this might be something that you want to consider if you meet the specifications. But let's give you an example. So let's just say your home is worth 400,000 and your remaining mortgage is 200,000. That gives you 200,000 pounds equity. Your loan to valuation would be 50% because 200,000 is half of 400,000. And lender may offer you a line of credit of, let's just say, 50,000, which you can use when needed for things like home renovation, starting a business, debt consolidation. You might only pay the interest on what you draw down from the 50,000. So let's just say you were looking to do some home improvements and you're doing a phased home improvement. You get a line of credit through this product for 50,000 pounds. But the first phase only costs 10,000. So you would pull out 10,000 and you'd only pay interest on the 10,000 that you've pulled out. Or it may be interest free. But the remaining 40,000 is still there and available to you, but you wouldn't be paying any interest on it because you haven't used that. So that would be an example of when this might be a good product for you or a circumstance in which you would actually use it. I always like to emphasize the downside to things because, as I said, internet influencers, they make their money off clicks. So what they will tend to do is talk about extreme things or things that's going to pique your interest, that you can go in there and say, wow, there's a way to take equity out of my home and it's interest free. I don't like to approach things like that because I am a licensed individual. And it's very important that you always, 100% of the time, even if you hear something from me, you do your own due diligence, you do your own research, you make sure that you speak to a licensed professional because I'm not giving financial, legal, or investing advice. But let's look at some of the risks, some of the cons to this. So one of the key challenges is the variable rates can go up or down. So you may get the line of credit for 50,000 pounds and then you take out 10,000. At one point, the interest rate might be one figure. At another point in the passing of time, that interest rate might change. As with every single mortgage or second charge, your home is at risk if you don't keep up your repayments. So if you're someone that is not good at managing your finances, this is not the product for you. Not all lenders offer this structure, so you'll need to speak to a specialist and the drawdown periods and limits apply. But let me just really talk around the credit side of things. So if you are someone that is not financially stable, if you're someone that struggles to manage your finances well, then probably this isn't a good product for you. There are other products on the market that might be a better fit, that might give you the result that you want in a more suitable way. So make sure that you speak to a mortgage broker. You can reach out to me. My information will be in the description. So, what is the criteria? This is what everybody wants to know. What is the criteria? So, first and foremost, you need to have a considerable amount of equity in your home. So, that means you have to have paid down a lot of the balance. If you just purchased your home and you've paid down a 5% or 10% deposit, then this is not the product for you. Okay, so you're going to need to have a considerable amount of equity in your home. You're going to have a great credit profile. So if you're struggling to pay your bills and you're missing payments and have late payments, have defaults, CCJs, anything like that, you're probably not going to qualify for this product, and it probably wouldn't be the best product for you anyway. As you watch this video, make sure that you put your comments in the comment section. And as with this video, I'm doing this video because it's something I've been asked about. If there's a product or if there's a particular part of mortgages that you'd like for me to talk about, make sure you put that in the comments. And don't forget to subscribe. There's lots of people that watch my videos and do find them valuable, but never subscribe. So just take a minute right now to subscribe to the channel. All right, so let me just answer the question. When is a home equity line of credit useful? So one of the scenarios would be if you're planning ongoing phase projects, not a single lump sum spend. So let's just say you're doing your bathroom, your kitchen, an extension, etc., and it's going to be done over the course of time. This might be good for you. If you want a safety net or contingency fund, so something that is there if you need it, because you foresee that there may be some challenges as far as paying school fees or whatever, you have equity, but you don't want to remortgage or disrupt your current mortgage deal. As I said, if you have a really low interest rate and that interest rate doesn't expire for another 2 years, but you need access to cash, this might be something that you look at because the existing mortgage will be there at that 1.9 or whatever your mortgage is on. You have available equity. You want to access some of that money, but you don't want to remortgage because, let's face it, if you took your mortgage out when the interest rates were really low, you'd be silly to remortgage for the sake of getting some additional funds, especially when products like this do exist. So let's just look at that first scenario, the home improvement scenario. So if you're planning a kitchen remodel now and then a loft conversion next year, you don't want to borrow the lump sum today. That would be silly, and pay the interest on money you're not even using for months or possibly several months. So a HELOC would work because you can borrow in phases. So you have access to a £50,000 line of credit. You do the kitchen for 10 grand. That must be a really small kitchen. But then you withdraw the rest of the money as you need it. You pay interest only on what you've drawn down. No need to remortgage or disturb the existing low rate. It's ideal for homeowners who want the flexibility over time. So that's a great scenario. So if you're looking to do a phased home improvement, you have equity in the property, you have good credit, and you want access to that money, a HELOC would be something that you might want to speak to your mortgage broker about. Another instance, and I do see a lot of people that are trying to fund private school or university fees. So you might want to help pay for your child's education, but the fees come in termly chunks. You have the equity in your home, but you don't want to take out a large loan up front because you might find that the interest rates are higher. So a HELOC works because you can draw down the funds when you need them. You repay as you go without paying interest on the unused funds, and it avoids the credit cards and personal loans with higher interest rates. Now, I'm not giving financial advice, and you might have a interest rate that's lower, but in general terms, it will help you avoid that. It's good for parents looking for a structured, lower cost way to manage a large debt, but with staggered expenses. So your child is going to university, you're sending your child to a private school. This would be a good opportunity for you to speak to your mortgage broker about a home equity line of credit. And lastly, for debt consolidation, and I kept this one until last because sometimes the fact that you're doing the debt consolidation, it may actually rule you out for this product. It may mean that this product is not good for you. But in the in the sense that it would be good for you, it would be if you're juggling multiple high interest debts. So high interest debit cards, car finance, a personal loan. And I want to emphasize high interest. So if these things are on high interest, if they're on 0% interest, then it's on 0% interest. And you want to consolidate into a manageable monthly payment. A HELOC might work because potentially it would lower the interest rate on those unsecured loans. You have the flexible repayments. And if you need it again in an emergency, you can redraw funds during the 5-year draw period if the particular product you get has that 5 years. It's ideal for homeowners with equity who want to tidy up their finances and free up monthly cash flow. So this is not for someone who's not managing their debt well. This is for someone who is paying their credit cards on time, is managing the debt. But what they're looking at is, all right, I have £15,000 worth of credit card debt. One interest rate is on X, another's on Y, another, and it's all over the place. And quite often people are just servicing the debt. And what I mean by that is they're paying every month, but because maybe they're just paying the minimum amount or a little bit over the minimum amount, you will find that your actual balance is not going down. Plus, if it's on a high interest rate, and I want to stress that, if it's on a high interest rate, it might make more sense to consolidate or put all of those things in one place that you have one payment. So you're not taking out any new debt. So £20,000 worth of credit card debt with different interest rates, due on different dates, all kind of things. You're not borrowing new money. You're transferring the £20,000 that you already owe onto another facility. Now, a home equity line of credit might not be the best facility. It may be better for you to just get a personal loan at a lower rate. So I'm not saying that this is always going to be the perfect solution. But as I said earlier, quite often people that this would be a good option to consider, they don't even know that it exists. So I just wanted to talk you through the product that you do know it exists, but I do want to stress to you that I'm not giving financial or legal advice and certainly not investment advice. So in summary, a HELOC style mortgage in the UK can offer flexibility and the access to equity without needing a full remortgage, but it's not as widely available or advertised under that name. If you're considering one, just give me a call. Like if it's something that you want more information about, I will give you advice and guidance, and we may have a conversation. And firstly, you may not qualify, or there may be a better product or a better way of going about accomplishing what you're looking to accomplish. My goal in this video is not to sell you on this product, but to give you better insight to it in a more nuanced way from a finance professional as opposed to a TikToker. In closing, a home equity line of credit or HELOC is a flexible borrowing facility secured against your home. And as with anything secured against your home is at risk if you don't keep up your repayments. It lets you unlock equity you've built up in your home and property, borrow money as you need it, not all at once, repay and redraw during a set period. This isn't a new mortgage, it's a second charge sitting behind your existing mortgage, which means as a second charge, your primary lender will need to give you permission, and it sits behind your other mortgage. So if it all goes pear-shaped, so if you do qualify for this because you've always managed your finances well, you have no credit issues, you have equity in the home, and you've done that for years, but things go pear-shaped, as they say, during this, your bank is coming for you for their money, and then the second charge is coming at you for their money. So you should always consider these things very carefully and always speak to a mortgage broker who understands your personal circumstances and is not looking to just sell you a product for their benefit. They should always be putting your needs first. My name is Anthony Lindsay, and as I said, I've been in finance for over 30 years. I've done debt collections, I've done wealth management, and I do mortgages and lending. So my discussions are very much nuanced. My QR code is on the screen. You can book an appointment with me. And we are really, really excited to announce the 6th annual East London Property Expo. So the 6th annual East London Property Expo. If you're looking to network with property investors, find out about products like HELOCs, bridging loans, anything, and ask questions from a panel of professionals who are not online influencers, but actual professionals who deal with clients every day. Please, please, please register for the East London Property Expo. It's taking place on March 21st, 2026. The big panels are free, but if you need more specialist advice or guidance or to speak to professionals, we do have master classes. We also have breakout sessions. So be sure to register. Registration is free for the seminars, and you will meet hundreds of people that you can then network with and learn from. How do you prepare? So if you're considering getting a HELOC or any type of mortgage product or remortgage or even a second charge, check how much equity you have in your home. Ideally, you're going to need or want at least 50% worth of equity. And the reason why that is because there's a maximum loan to valuation that the home equity line of credit can take you to. So if you're already there, it's going to be a pointless product. Check your credit report. You must have excellent credit for this product. So quite often I speak to people and they think that their credit is a lot better than it actually is. And we're not talking about credit score. So we're not talking about the number that you get from your bank stating your credit score is this particular thing. The credit score is one aspect of having good credit. But for these type of products, more likely than not, you must never have missed a payment or had late payments or CCJs or defaults or anything of that nature. That's not to say that some lenders who offer this product may not consider those things. But if you're going into the conversation understanding that it's important that you have good credit, a comfortable amount of equity, you're probably not going to be disappointed. The other thing I would say is have a plan. Do not watch me or watch someone online and then just jump into it. Have a plan. If you are looking to do renovations, make sure you have quotes from a good builder. Make sure you're working with someone that you trust. And also, I would say, make sure if you do enter into this product, that you're getting as much as you will need and overage. It's very rare that I've seen someone do a home improvement and it's come in on time and on budget. And the great thing about this product is even if you get a line of credit for, let's again say 50,000 and you think the project is only going to cost 30,000, it's fine because if you only use the 30,000, that's the only part that you're going to pay any interest on. So I would say make sure you have a plan. Make sure you speak to a mortgage broker. You will find that there are a lot of mortgage brokers that aren't familiar with the product. And if they're not familiar with the product, they might not be able to give you the best advice. That's one of the reasons why I'm doing this video, that you can understand some of the pros, some of the cons, and at least open up the conversation. But if your mortgage broker is telling you that it's not something that they're familiar with, you should probably speak to a broker who is more familiar with the product, that they can give you the best guidance. And planning is always key. This is not, to be used or abused. This is a great product for the right type of client. And we do have some client profiles that tend to fit this. The type of clients that tend to fit this product do tend to be older people. They're for people who don't want to remortgage. They have a good credit rate, good credit rating. They're looking to do ongoing building, or they just have ongoing needs, but they don't need the lump sum. And they prefer interest-only payments during the drawdown period to maintain cash flow. So I went by interest only, saying that you're only paying interest on the money that you actually utilize, not the entire credit limit. So again, using the analogy of a credit card, if you have a £10,000 American Express credit limit and you only use £500, if you're paying interest, you're only paying interest on the £500, not the remaining 9,500. It's something to be considered, and hopefully I've given you an overview of the product. If you'd like to know more, if you'd like to have a conversation and see if this product could be good for you, or you may know someone who is one of those people that's seen a TikToker talking about the product, and the person is actually talking about the US market and not the UK. If you know any builders, any investors, anyone in that realm of property that may benefit from understanding what a home equity line of credit is, how it could be used, and if it potentially is the right thing for them, make sure you share the video. And as always, make sure you like, make sure you share, make sure you comment. If there's a product or a service or an aspect of mortgages, property that you'd like for me to discuss or like for me to investigate a little bit more about and just share my thoughts, please put that in the comment. Most people watch but don't subscribe. By subscribing, it means that you get access to the videos as I do them. I tend to do a couple of videos per week. I do my best to talk about the things that people are asking me daily, because what I found with mortgages is quite often it's the same questions. Like, most people have the same questions. So it's useful to have this resource in a way that I'm not trying to sell you something. You can take this information and then question it with your mortgage broker. But if you don't have a mortgage broker and you're looking to purchase your first home, remortgage, refinance, release equity, anything like that, please reach out to me. My advice is always to speak to a mortgage broker 6 months before you think you actually need them, because quite often the things that we can do to help you prepare to get the best product for you and your circumstances and your risk appetite, we need 6 months to tidy up some things, because you might look at your credit report and there's something on there that you didn't think was there. My name is Anthony Lindsay. You can use the QR code to book an appointment. And don't forget, I have a new book called A Mortgage is a Really Big Loan. I talk about different aspects of finance, not just mortgages. And I always appreciate you watching. Make sure you like, make sure you subscribe, and make sure you comment.